So, Matt, thank you very much for the kind introduction. Grateful to you personally, to Verivest team, to Fairway team for many great years. I've learned a lot from you personally, and I'm very honored and humbled to be working within your ecosystem. So I appreciate you and appreciate Fairway and Verivest ecosystem. So just a couple of things. Again, this is formal discussion, a lot of boring topics. So I'm going to start with a joke. I hope you all can appreciate, get a little warmed up. So I do run a podcast called Big Mike Fund Podcast. I know it sounds cheesy, but I'm a big guy. People call me Big Mike. So, and people have often asked me, I've been on other podcasts, they ask me, how do I get a hold of you? And I tell them, bigmikefund.com. And then I say it, bigmikefund.com, and I forget the D at the end. And I tell folks, listen, if you don't like bigmikefund.com, go to bigmikefund.com. I promise it's not a kinky site. All right, today we're going to talk about investing for growth with better safety, higher safety, or with great tax benefits. And the reason I say both, because you got to pick and choose your battles. Like Matt said, you can't win them all in one transaction, one fund. You could invest for growth with a lot of safety or greater safety, and you can invest for growth with a lot of tax benefits. And we're going to talk about that. First of all, wonderful disclaimer, lawyers require this. So this is informational, educational, not soliciting anything. If you're interested to invest in our family of funds, please request PPM to accredited investors only, consult your attorney and CPA professional. Here is our team. So a couple of folks from our team are here. Alina, as you can see on the left top corner. Please, when you get a chance, say hello. And also Steve, our marketing manager, is also here by the booth. So appreciate if you will get to know them. They're awesome folks. So why folks invest with us? We've been doing real estate. I've personally been doing real estate since 2000. I live in New York. I've done investments in New York City. I've discovered a lot of other things, great investment opportunities outside of New York, and this is where we focused over the last since, I guess, 12, 13 years. So we've done a lot of investing. We've got a strong track record, and that's one of the reasons folks invest with us. One of the major benefits that we provide to many folks like you is broad diversification. We diversify among many dimensions of diversification. Different geographic regions, different strategies. We run effectively what is known fund of funds. Each of our funds is a fund of funds. We are capital allocators. We're dynamic. We change strategy. We change location. We change the amount of capital we deploy, the duration of the capital, all for the benefit of the investors, adjusting with times. Also, our funds present best access point. We invest in deals that are available to public and deals that are private that you can't get access to only through our funds. So we mix and match, and when we invest into other deals, because we are a fund of funds, we are programmatic capital allocator, we're able to get often terms better than generally available to public. We'll write a bigger check, more programmatic check, and we negotiate better terms through side letters and other methodologies. We pride ourselves on white glove service. Meet Alina, please. Take the opportunity to get to know her. She's awesome, and we serve you. This is our most valuable asset, the relationship with you, our investors. We're fully transparent. We are very happy to be on Verivest. We are one of the Verivest verified gold folks. Verivest does fund administration. They monitor us. They do all the financials. It works really well for us, and it works very well for you, as there's no Bernie Madoff business. It's impossible. For those folks who do the books in-house and do their own audits in-house, they run this risk. When we run with Verivest and external third-party auditors, it's an impossible transaction. Why it's important? Well, as investors, you want to have confidence that the books are done right, and that's why we are happy and proud to have Verivest as our fund administrator. We communicate often through the portal, including Verivest portal, Zoom calls, quarterly update calls, newsletters, and so on. So now we're going to get to the crux of the presentation. This is one of the most important slides in the whole presentation, and for those of you who like apples or oranges, it's for you. And if you'd like a different fruit, I'm sorry I've only used these two. But the concept is very powerful. In the traditional model, most of the deals in real estate are done with, firstly, the mortgage, the bank debt, and then the equity investment. So when you invest in a, say, multifamily deal, the classic structure is when you have common equity behind the bank debt. And in that scenario, investors receive proportional benefit, pari passu amount of depreciation, pari passu amount of safety, pari passu amount of cash flow. So that is a classic model. It has been used many times, and it works. But there is a better way. It is not a better way every time. It is not a better way for every deal. But for many deals and many situations, there's a better way. And a better way is when you take equity and you break it into two chunks. One is preferred, the other one is common. So preferred equity typically enjoys higher safety, seniority of the cash flow, seniority of return of capital. In return, the preferred equity doesn't take any tax benefits. They don't take any depreciation. And then the common equity gets more of the other benefits. So again, preferred equity gets all the oranges, and the common equity gets all the apples. And apples could be things like depreciation. Also, common equity could have a greater upside. They take on a higher level of risk, but the counterbalancing factor is additional upside potential. And you'll see that system implemented in Tempo Growth Fund 2, which we are very happy to have launched in March. It's been very successful so far. And we learned from our own experience of having launched a very successful fund, Tempo Growth Fund, just the first one. And that fund closed and stopped raising capital in January of this year, and when we launched Tempo Growth Fund 2. But one of the lessons learned from launching a successful fund like Tempo Growth Fund was that there are plenty of investors who don't want any depreciation. They want higher safety. For example, IRA investors, those dollars couldn't do anything with depreciation. In addition, there are plenty of cash investors that don't need a lot of depreciation. On the other side, there are folks that need a lot of it. For example, if you sold appreciated real estate and you wanted to use depreciation to offset the gains from sale, or you have other passive real estate rental income and you want depreciation to help you offset those gains. Or you're a real estate professional and you can use depreciation to offset other income. So the power of this structure is immense. And now we're going to move to a very, unfortunately, very cluttered slide. This works really well on Zoom. I hope you can see this. But on a big screen, again, with a little bit of focus, I'll talk through this slide. So this fund is a growth-focused fund. First of all, it is not an income fund. Really important. This is investing for growth. We do have an income fund. That's a separate discussion. But for this fund, it's a growth-focused with a time horizon of 5 to 7 years. It's well diversified, as I mentioned, multiple strategies, multiple locations, multiple operators, and invested over a period of 2 years. So we spread the risk, we diversify for you. That's one of the major benefits of the fund. But the structure of the fund has Class A or preferred equity units. So the Class A preferred equity units represents roughly 60% of the fund. So we're raising total $25 million in the fund. In the fund, Class A units, the preferred equity units, are $15 million. And then the common equity units are $10 million, which is about 40%, and 60% is in the preferred. Why it matters? Well, if you do a real basic math, you can begin to understand how it works. So preferred equity units have a high pref. The fund provides 12% cumulative preferred return. So every year it accumulates, but there's no distributions. And then the Class B units, the common equity units, have only 8% pref. The Class A units are much more attractive if you're looking for a high pref, 12 pref versus 8. In addition, the pref to Class A units, to preferred equity units, is senior to the Class B pref. Now, real benefits come in to the folks that are looking for safety. Return of capital is senior to the preferred equity units, the Class A units. This is very important. If you are investing for growth, investing your IRA money, and you want higher safety, the Class A is a lot more attractive because you're first to get the pref and you're first to get the capital back. So what does it do? It creates substantially higher safety. It's not guaranteed, but it's almost like a floor. 12% pref, then 8% pref to Class B, and then the return of capital to Class A. So the Class A folks feel safer. They feel that these Class B dollars behind them. And then the trade-off is all the depreciation benefits, all the operating losses, all the losses flow to the Class B members. And this is important because Class B folks get massive tax benefits. So our projection that the Class B folks, for every dollar that they invest, will get at least $2 of depreciation. $100,000 investment would get $200,000 depreciation-driven losses, K1 bucks 2 losses of at least $200,000. Now I'm going to say this with a disclaimer that it is very possible that that number will exceed 2x. It's very possible we'll wind up at 2.5x. What we don't know is what's going to happen over the next 2 months, but we have some deals on the horizon. We know the fund portfolio as of today. There's a pretty good possibility that the 2x will wind up being 2.5x. And I say with a full disclaimer, read the PPM, and no guarantees, but we just know what the composition of the fund looks like today. So the depreciation benefits are massive. You write a check for $100,000, you get $200,000 or $250,000 first-year loss, and if you can use that to offset gains, you paid for the whole investment and tax savings immediately. It's a very powerful, and we'll talk about other use cases on this. The upside for investors in preferred equity, they receive 30% of the upside once the capital is returned. So it's 12 pref to Class A, 8 pref to Class B, return of capital to Class A, return of capital to Class B, and then the upside, the performance is split, 30% upside to Class A members and 70% to Class B. So you can see how Class B can outperform the Class A if the fund does well, but that's by design. General preferred equity has a higher safety, less upside, and the common equity is taking more risk, but it has a greater upside. So target return for Class A is 13 to 17% per year, and to Class B, it's 12 to 18%. It's a broader range because it takes more risk. It can substantially outperform or it can underperform. So just a couple of points. As far as our compensation as fund managers, we do receive a promote, and depending on the dollar amount folks invest, the promote is different. So folks that have $1 million within Tempo ecosystem. So we have Tempo family of funds. We'll talk about this in just a couple of minutes, but we have Tempo Growth Fund 2, we have Tempo Income Fund, Tempo Opportunity Fund. If you have combined balance, we call it relationship balance of at least $1 million, you're basically an 80-20 split on the upside. Our performance fee is only 20% and 80% goes to you as the investor. If you have $500,000 in our ecosystem, that's the relationship balance, then it's a 70-30 split, and everything below is 60-40 split if you don't have $500,000 within our ecosystem. This is what performance fees look like. So the fund launched in March. We've raised at this point close to $13 million. When I put the slide together, this was 12.3, but the number is obviously growing. And as you can see here, about 2/3 of it is preferred equity, and about 1/3 of it is common equity. The target is to have about 60% preferred, common 40%. That ratio between preferred and common magnifies depreciation benefits to the common units. As you can see, 2-to-1 ratio provides more depreciation than 60-40. So what the fund invests in, the fund invests in a broad range of asset classes. Again, we're capital allocators. So we invest in distressed commercial debt, first lien position secured by real estate at conservative loan-to-value ratios. Also, we invest into a lot of value-add projects in multiple asset classes on the equity side. Self-storage, value-add multifamily. We love working with Fairway and Vivo, hotel conversions to multifamily. That's a great do-good strategy. Creates affordable housing, really important for the country, for the affordability. So we love that strategy. We love also value-add projects in open door retail, a number of other strategies, industrial, and so on and so forth. So the fund is very opportunistic and broadly diversified, spreading the dollars that investors provide into multiple strategies, locations, operators, and so on and so forth. So here's a quick comparison between preferred and common equity, some of the key benefits. So preferred equity obviously provides higher safety than the common equity, which is a critical element of consideration for preferred equity. It is IRA friendly. Not only it's IRA friendly, we have multiple folks that have utilized an advanced strategy They basically invested IRA money, traditional IRA, in the fund, and then they were able to obtain a discounted current valuation letter due to the lack of liquidity and lack of control. I'll cover that on the next slide, and convert it to Roth IRA. Quest is here. We do a lot of work with Quest, and they've been absolutely awesome to work with. Many folks follow a real simple process. They invest. Instead of converting cash, they invest in the fund, and 2 weeks later, they request a letter from a CPA, which we're happy to introduce him to, who's done these letters, that'll offer a valuation opinion. We don't get involved at all. It is the CPA's opinion, the licensed party, that because the investment is illiquid, it's locked in for 5 to 7 years, and the investor doesn't have control, they can get discount to cash due to that. As a result, the conversion value is less than the cash they invested, and they get substantial discount, and that helps them save on taxes. One of the advanced strategies folks have used the fund for. And on the common equity side, there's more risk, no question about this. The common equity is behind preferred equity, but they also have a greater upside. And then the tax benefits are just massive. And some of the use cases that folks utilize this fund for is the depreciation can be used to offset other passive income, or it can also be used to offset other income if they are real estate professionals. And passive income, capital gain, is a form of a passive income. So if you happen to sell appreciated real estate and you need a deduction, we call it tax loss harvesting. So you could harvest the losses from this fund to help offset gains from other passive investments, including capital gains. Consulting with your CPA professional, but that is our best understanding how it works. And we've spoken with many CPAs. This has been the industry standard. So this could be utilized instead of doing 1031 exchange. You could sell the asset outright, take the capital gains, and invest the dollars in the fund at the 2-to-1 ratio, and use the losses to help offset capital gains or other passive income. Very powerful strategies. Again, I mentioned these things. These are the couple of use cases. As I mentioned, traditional to Roth conversion, as well as the use of the common equity losses to help offset other gains. Just a couple of words about other funds we have. So we talked about Tempo Growth Fund. We also have an income fund, Tempo Income Fund. That fund targets to return between 8 to 15% a year, depending on the class of units. And its income focus, this fund is an open-ended fund versus the Tempo Growth Fund 2, which is a closed-ended fund. I wanted to make sure I differentiate. Tempo Opportunity Fund is also an open-ended fund, evergreen, and that fund has a target return 10 to 13%. In this fund, the Tempo Opportunity Fund, we do something that Voyager mentioned, and many of you are familiar with Fairway Fund 7 and 7QP. We do quarterly mark-to-market. We value the portfolio and we adjust price per unit. So it both distributes current income as well as it has elements of appreciation. So those are the funds. Stop by the booth. We're happy to give you more information on both the Tempo Growth Fund 2, Tempo Income Fund, and Tempo Opportunity Fund. And again, here's Alina. Please take the opportunity to reach out, see her. She's around somewhere, and talk to her. She does better job talking to you than I do. So please talk to her. And I'm happy to answer any questions as well. Appreciate you very much. Any questions?
When you make that Roth conversion, what's the typical discount that the accountant is opining on?
It's a great question, so I will use it with a disclaimer. I'm not an accountant and I don't play one on TV. I have seen discounts north of 50%. For roughly 25% for lack of liquidity, 25% for lack of control. It's between you and the accountant.
And the audits from IRS?
We have not had any audits. Quest is here. Years ago, I talked to Quincy Long, the founder of Quest. He said, you know what percentage of IRA accounts get audited? You can count them on one hand. Very, very small number. There's a little bit of risk. They come in and then they challenge it, and then you deal with that point. They impose some penalty. But every type of risk has two elements: risk, likelihood, and impact. Likelihood is very, very small. Impact, maybe IRS will disallow 50% discount, they'll say, okay, 30% was reasonable. You're going to have to deal with a little more tax liability. But the likelihood is pretty low. Thank you.
Thanks, Ron.